Okay, so let's unpack this. We've got this stack of source material right here. Investment memos, articles, commentary, and it's all focused on one name, Hermès International.
Right. And our goal in this deep dive, really for you listening, is to boil all this down. What actually makes Hermès work? Why do people consistently call it this, wonderful company?
And maybe the big question, based only on what these sources are telling us, could it actually be a solid long-term investment?
Yeah, it's fascinating, isn't it? There's this core tension.
How does a company selling handbags, really expensive handbags, tens of thousands of euros, not just survive, but thrive like this consistently?
So we need to look beyond that sort of mystique, see what these sources say about the real strengths, and just as importantly, any hidden risks.
Exactly. Think of this as your fast track to grasping the key insights from all this material.
Okay, so where do we start? The business model itself, I think. How does Hermès actually make money?
Well, the sources describe it as this masterclass in vertical integration. They pretty much own and control the whole chain.
From design, sourcing.
Yeah, right through manufacturing, all the way to the final sale in their own stores.
Okay.
And the focus is totally on timeless, artisanal luxury goods. It's like the opposite of fast fashion.
And that control, that vertical integration, it's crucial for them. It's how they maintain that obsessive quality and consistency. That's central to the whole story.
Definitely. Now, looking at the numbers these sources lay out, for 2024, revenue was $15.2 billion. Pretty substantial. And they break it down by what they call métier crafts, basically.
Right.
Leather goods and saddlery, that's the powerhouse. It consistently brings in somewhere between, say, 41% and 50% of the total revenue.
That really tells you where the economic heart of the business is. But they're not entirely dependent on it.
No, not at all. Ready-to-wear and accessories, that's about 29%. Silk and textiles, around 7%. And then you've got perfumes, watches, jewelry making up the rest.
But leather goods is the engine.
Absolutely. That's where the core profitability really sits.
And how do these, exquisite products actually get to the customer?
The distribution is just as controlled as the making. It's almost entirely through this exclusive global network, about 311 boutiques, the sources say that Hermès owns directly.
Total command over the brand, the experience.
Exactly. How the customer interacts with Hermès, they control that completely. Digital is there, yeah, but the sources make it clear it's secondary.
And this whole controlled approach, it feeds directly into their, frankly, extraordinary profitability.
Right.
The sources point to two main things. Huge brand desirability, obviously, but also, critically, a deliberate strategy of limited supply.
Yes. That's the magic formula, isn't it? That combo creates unbelievable pricing power.
Unbelievable's right.
The sources talk about gross margins consistently, over 70%. And operating margins hitting, over 40% in 2024?
These numbers aren't just high for retail, they're almost in a different stratosphere.
So when you boil it right down, like the sources do, the model is actually quite simple on the surface.
Yeah, deceptively simple.
Make the absolute best quality stuff you can, produce less than people want, sell it for a high price through your own exclusive shops.
Simple, yet it works. And it's endured for decades. Why? Why is it so durable?
This is where it gets really interesting. The sources argue it taps into some really deep, fundamental aspects of human psychology.
Okay, explain that.
Hermès products are classic Veblen goods. That's an economic idea where demand actually increases as the price goes up.
Because the high price itself is the signal.
Exactly. It signals status, wealth, and the sources suggest that this basic human desire for status, it's not just a trend, it's structural. It's always there.
And then there's the scarcity piece.
The intended scarcity, yeah. This isn't an accident of production limits. It's meticulously managed. The sources talk about the famous waiting lists, the need to build up a purchase history.
Often called the game by customers.
Right, the game. And cultivating relationships with sales associates, or SAs.
It turns buying into a quest, doesn't it? Making the item feel like a trophy you've earned.
It taps into that very human drive for something that's just out of reach, the unattainable.
Makes sense.
And one more thing the sources highlight. In a world that feels increasingly disposable, the sheer, tangible, lasting quality of Hermès stuff offers a sense of permanence.
Like an anchor.
Yeah. They quote Axel Dumas, the chairman, talking about creating companion objects designed to last and gain a patina.
That's a great phrase. And this idea of the product being a refuge in uncertain times, I can see that. Plus, the fact that bags, especially, are seen as actual investments that can appreciate.
It just adds another layer to that feeling of enduring value.
Okay, so we get the business model, the psychology. What about the competition? What protects this? The economic moat, as they call it.
Right, the moat. The sources describe it as, well, formidable, a real fortress.
And interestingly, it's not built on the usual things like being the cheapest producer or having some kind of network effect. It's fundamentally built on layers of intangible assets.
The sources break it down into three main pillars. First, brand heritage and history. You're talking almost 200 years of legacy authenticity.
You just can't replicate that overnight. Time is the one thing you can't buy.
Exactly. That's the foundation. Second pillar, manufactured scarcity and exclusivity. This is the active part, the strategy of deliberately keeping supply tight below demand.
That's the engine constantly generating that desire, upholding the exclusivity.
And the third pillar flows from those two, unmatched pricing power. The heritage plus the scarcity lets them price based on perceived value, not cost.
Which makes them incredibly insulated from things like inflation or what competitors are doing on price.
You see this moat working most clearly with the iconic bags, the Birkin and the Kelly. The sources explain the Hermès game needing the SA relationship, the expectation of serious pre-spend.
Sometimes tens of thousands of dollars, yeah, just for the chance to be offered one.
That's kind of mind-boggling. No competitor, however rich, can really demand that level of upfront commitment before you even see a main product.
And look at the secondary market. That's the ultimate proof of their pricing power, isn't it?
Absolutely. Bags selling for double, triple, sometimes way more than retail.
Which tells you Hermès is knowingly, strategically underpricing its most iconic items at the boutique level.
It seems irrational at first glance. Why leave that money on the table?
But the sources argue it's genius. That huge unmet demand at the top spills over. People buy other things, scarves, belts, jewelry maybe as consolation prizes, or just to build that purchase history for the game.
So those other purchases effectively subsidize the marketing for the whole brand.
Exactly. And those sky-high resale values, they're constant free advertising. They reinforce the idea that these aren't just bags, they're assets, which just fuels more demand back at the stores.
What really stood out from these sources, though, is the argument that this moat isn't just strong, it's actually getting wider.
They make a strong case. Financially, Hermès consistently outgrows the rest of the luxury sector. Think 11% compound annual revenue growth versus maybe 7-8% for peers historically.
And the margins, wow. EBITDA margins expanding from around 27.5% to over 40% in 15 years.
Look at 2024, 15% constant currency growth, 40.5% margin. That shows incredible resilience, even when other luxury players were struggling a bit.
Suggests they're taking share, strengthening that pricing power. And strategically, where they put their money, it's all about deepening the moat.
Huge capital spending, what was it, $1.1 billion in operating investments in 2024, mostly on building new workshops in France.
Which directly tackles their main constraint.
Yeah.
Getting enough skilled artisans to make more stuff without ever compromising that quality.
And they're buying key suppliers too, like J3L, Perrin and Fils.
More vertical integration.
Yeah.
Securing the supply chain, preserving that specialist know-how, the craft.
And defensively, the sources really emphasize the family control structure. Remember how they fortified it after LVMH tried to build a stake years ago?
Yeah.
That structure protects the long-term, patient artisanal strategy from short-term market whims. It's a crucial part of the fortress walls.
Okay, let's shift gears a bit. Step away from the financials and look at the scuttlebutt, what the sources picked up from real people, customers, employees. And it's quite a contrast.
It really is. With customers, you see this deep love for the products. The quality, the craft, the heritage people adore the actual items.
There's real joy, gratitude when they finally get that bag or scarf they wanted. They see them as art, as investments.
The process of getting them, especially the most sought-after ones, that's where you hear the frustration.
Yeah, the sources paint a picture of the game for quota bags being draining, opaque, sometimes feeling, well, disrespectful, especially if you're a new customer.
Complaints about the power the essays hold, feeling pressured to buy things you don't really want just to build your profile, inconsistent online service.
There's that quote one source found on Reddit, someone feeling like they were begging a luxury brand to let me spend money. And there was an example of someone having a real headache dealing with a faulty item, too.
So you have to ask, like the sources do, is this friction a flaw in the system, or is it actually part of the design?
And the sources lean towards feature.
Yeah, it seems counterintuitive, but the argument is it filters out people who aren't truly committed. It makes getting the item feel like a major achievement, which reinforces the exclusivity.
Your top-tier, long-term clients probably have a much smoother ride.
Almost certainly.
Yeah.
So the friction the broader market feels, paradoxically, it might actually enhance the very exclusivity that draws people in.
Interesting. What about the employees? What's the sentiment inside the company?
It seems like a mix. A lot of pride, but also some pressure.
Okay.
On the plus side, turnover is reportedly very low, which is vital for keeping those skilled artisans. Employees talk about pride in the brand, the quality, the culture. Hermès gets voted a top employer in France. Things like pride and belonging come up, and apparently the benefits are quite generous. But the sources also picked up hints of a demanding, maybe somewhat arrogant internal culture. One consultant apparently described working with them as horrid, mentioning drama queens, with a holier-than-thou attitude.
The dark side of perfectionism, maybe.
Could be. But ultimately, the low turnover suggests that for most employees, the positives, the pride, the stability, the benefits outweigh the negatives. And retaining that talent is absolutely critical for the long-term health of the business and its quality promise.
Right. Okay, so we've covered the business, the moat, the scuttlebutt. Let's look upstairs at the leadership, management stewardship.
So it's led by Executive Chairman Axel Dumas, sixth generation of the founding family, CEO since 2014. That direct family lineage is seen as absolutely central.
Aye.
It ensures the leadership is inherently aligned with that long-term, patient, artisanal vision. It's in the DNA, so to speak.
And his philosophy, based on shareholder letters the sources reviewed, it's all about those enduring values, making objects designed to last, that uncompromising quality, preserving the craft, the know-how.
It's a very patient approach, clearly not driven by quarterly results or market fads. He puts people and the craft at the very center of what they call the artisanal model.
And how does that translate into how they spend their money? Capital allocation.
The sources basically call it a master class in rationality. It lines up perfectly with that long-term philosophy.
So top priority for cash.
Reinvesting right back into strengthening that core moat. We mentioned the big CapEx, that $1.1 billion in operating investments in 2024, mostly for new and expanded production facilities in France.
Directly investing in making more high-quality goods, carefully.
Exactly.
Yeah.
Addressing the main bottleneck. And then there are those strategic acquisitions of key suppliers like J3L and Perrin and Phil's.
Which again is about controlling the quality, securing rare materials or skills, preserving that vital know-how.
And what's really telling is what they don't do. They explicitly avoid big, splashy M&A outside their core.
Right. Uma was quoted saying something like, "We know how to do Hermès, I'm not sure we know how to do anything else."
That's incredibly disciplined, isn't it? No empire building for its own sake. They focus capital only where they have that deep, almost unassailable competitive advantage.
So only after all that reinvestment.
Only then do they return the excess cash to shareholders, primarily through a steady, growing dividend. $2.6 billion paid out in 2024. No signs of big opportunistic share buybacks.
So the verdict from the sources is pretty clear. Management passes the rationality test.
With flying colors, rational decisions, good for shareholders in the long run, capital allocation reinforces the moat, checks all the boxes.
And the financial results reflect this. The sources describe a powerful, incredibly reliable earnings machine.
Yeah, high revenue growth at 10-year compound rate was 14%. Operating margins that are peerless and still expanding, consistently over 40% now.
And that resilience we talked about, performing strongly even when the wider luxury market faces headwinds.
The sources also highlight really strong underlying economics through key ratios, things like return on invested capital, ROIC, strong free cash flow conversion, and a very healthy balance sheet with low debt. It really is a financial fortress.
Okay. Business, moat, management, financials, all sound incredibly strong. Which brings us to the really tricky part for anyone looking at this today. Valuation. What's the price tag?
Yeah, this is the elephant in the room. The sources are unanimous. The market puts a very, very high premium on Hermès shares.
We're talking high price to earnings ratios, high price to free cash flow. By almost any standard metric, the stock looks expensive. And it has for a long time.
So the crucial judgment offered in these materials is that the current price is definitely a demanding entry point. Meaning those high multiples don't leave much room for error. If anything goes wrong, or even if growth slows slightly, the valuation could take a hit.
As if this is a really important but in the sources for an investor thinking in terms of decades, not years or quarters, paying that premium might actually be rational.
Explain that logic.
The argument is you're essentially buying a piece of what they describe as a near perfectly managed, competitively unassailable business.
So the quality justifies the price.
Over the very long term, potentially yes. It comes down to the power of compounding. The idea is that the premium valuation reflects this unique quality and durability. If the business can keep compounding its intrinsic value at a high rate for decades, that growth rate becomes much more important than the initial entry multiple.
Okay, so if someone were to invest, what are the main growth drivers going forward, according to these sources?
Two big ones stand out. First, just the continued global growth of wealth. More high-net-worth individuals around the world, especially in emerging economies, means a bigger pool of potential Hermès customers over time.
Makes sense. The customer base expands naturally.
And second, something we touched on, that huge, largely untapped latent pricing power.
Ah, yes, the secondary market clue.
Exactly. The fact that Birkins and Kellys sell for multiples of retail shows. Hermès has enormous room to raise prices on its core products, probably significantly, without killing demand. Very few companies have that kind of leverage.
Okay, growth potential seems there, but let's talk risk again. What are the real dangers? The things that could cause permanent damage to this business's earning power?
The number one risk, the most significant one highlighted across the sources, is brand dilution.
How would that happen?
If a future management team, maybe one less connected to the family ethos, decided to chase short-term growth by making the brand too accessible.
Like significantly ramping up production.
Yeah, or selling through department stores, starting to discount, maybe mass licensing the name onto cheaper goods, anything that shatters that carefully built wall of scarcity and mystique.
That would directly attack the pricing power, the core of the moat.
Absolutely. And the sources explicitly point to the continued family stewardship as the key bulwark against this existential threat.
What other major risks?
Disruption to the artisanal supply chain. They need those highly skilled craftspeople in France. If they struggle to recruit and train the next generation, or if there's a major problem sourcing their specific high-quality raw materials,
that could cripple production or force compromises on quality, which would be terrible for the brand reputation.
And the third big one is more societal. A potential long-term shift in values among the ultra-wealthy.
Meaning?
A move away from physical luxury goods as the primary status signal. Maybe towards experiences, philanthropy, digital status symbols, or just different ethical considerations around consumption and sustainability that might view traditional luxury less favorably over time.
A fundamental shift in what status means.
Exactly.
Okay, let's quickly look at how the general market views Hermès versus maybe a more contrarian take found in these sources.
Right. The market consensus seems to be Hermès is amazing, truly exceptional company, unparalleled brand. Be it the stock is always and prohibitively expensive.
So analysts might say buy or hold, but often with cautious price targets because that valuation is just so high relative to peers or historical norms.
But the contrarian view, which comes through strongly in some of this material, is that the market consistently underestimates the durability and the long-term compounding power of this business.
How so?
They argue that typical market tools, 12-month price targets, relative PE ratios, just aren't equipped to properly value a moat that could potentially last for generations, maybe almost indefinitely.
And they see the family ownership not just as a nice feature, but as the absolute keystone, the critical element protecting that unique long-term strategy.
So where the market sees an expensive stock they might trade, this view sees a unique compounding machine, where paying a premium is a logical entry fee if you plan to be an owner for decades.
Fascinating contrast. Which brings us perfectly to the final challenge, the red team perspective. How could buying Hermès today, even with a decades-long view, turn out to be a huge mistake?
This involves flipping the bull case right over, it asks. What if this entire analysis is overestimating how permanent Hermès' cultural relevance really is? And what if it's underestimating the potential for disruptive social change?
So the idea that the desire for a Birkin might not be timeless after all.
Exactly. Maybe it's more of a cultural artifact of our time or the last few decades, rather than an eternal symbol.
Walk me through how that failure scenario might play out.
Okay, imagine this. A new generation of wealthy emerges globally. They look at the Hermès game, the waiting lists, the pre-spend, the SA relationships, and they see it as, well, old-fashioned, wasteful, maybe even a bit distasteful. A symbol of old-world excess that doesn't resonate with their values.
Their definition of status shifts. Maybe it's about impact or experiences or digital identity, not about owning a specific physical object. The Birkin becomes culturally dated, like how a mink coat might be viewed by many today.
Right. And at the same time, maybe that artisan supply chain really does start to fray. Fewer young people in France want to dedicate years to mastering these crafts. production gets constrained, or quality maybe even subtly slips.
Then perhaps under a new management team, maybe one with less family influence, facing pressure for growth in this new environment. They make the call.
They yield. They increase production significantly, maybe try selling through more channels to reach this new generation. They make the brand more accessible.
Boom, the mystique is gone. The scarcity vanishes.
Pricing power collapses. Margins start to look more like, well, a normal retailer's. And that huge valuation premium, the one built entirely on perceived permanence and unparalleled profitability, it evaporates.
So the investor who paid today's high PE ratio sees it plummet, maybe from over 50 down to 20 or less. Even if Hermès survives as a company, the investor faces huge permanent loss of capital.
That's the risk. Paying a massive premium for perceived permanence that turns out not to be permanent after all because culture shifted underneath it.
Wow. Okay, so bringing this whole deep dive together.
What these sources really paint is a picture of Hermès as this truly exceptional, maybe unique combination. Timeless craft, a deep understanding of human psychology, and just incredible financial strength.
It really stands out based on this material as perhaps the ultimate example of an enduring luxury business built on those intangible assets we discussed.
The analysis definitely points to a powerful, maybe even widening competitive moat, all steered by this unusually rational, long-term focused family leadership.
But as that Red Team Challenge just showed us, the risks are absolutely real and need serious consideration. That threat of brand dilution is always there.
And that more subtle but potentially profound risk that even core human desires for status might evolve, might find new expressions that eventually leave the current Hermès model behind.
Yeah, it really leaves you with a final thought to chew on, doesn't it?
Which is?
Given that potential for disruption, those shifting values, especially maybe across generations, is that deep human desire for status and exclusivity truly timeless in how it expresses itself?
Or is it actually possible that even the most powerful cultural symbols, like a Birkin bag today, could eventually lose their symbolic power in a world that's fundamentally changed?
And if that happened, what would it really mean for a business built so completely, so successfully on exactly that symbolic value?